Welcome! This is the ATRAM webinar series. We are about to start in a few minutes.
Do you want to make your money work for you but find investment intimidating? Do you want to build towards a better future? With ATRAM Group's funds, you can invest according to your interests and values. Investing is now made easier and affordable. Step into your future self, invest to reach your goals and aspirations. Matching your risk appetite and investment horizon has never been this easy. Let us help you maximize your earning potential by writing the growth story of the Philippine economy and opening your doors to the international trends in the global markets. Let us prepare you for a better financial future. At ATRAM, we're making lives better through investing.
Welcome! This is the ATRAM webinar series. We are about to start in a few minutes.
Greetings, everyone. Welcome to the Multi-Asset Income Investing webinar featuring the ATRAM US Multi-Asset Income Feeder Fund via ATRAM Prime. I am Christine Bernales from the investments team, and I will be your host for this fine afternoon. In today's fast-paced and ever-changing financial landscape, investors seek strategies that not only provide attractive returns, but also offer stability and security. Multi-asset income investing has emerged as a compelling approach that diversifies investments across stocks, bonds, real estate investment trusts, master limited partnerships, preferred stocks, and other income-generating securities. Today, we will deep dive into the significance of capital preservation and income generation in the context of multi-asset income investing. We will explore how this aspect remains a crucial component of the overall investment strategy, ensuring the preservation of initial value of investments and mitigating the impact of market volatility. Join us as we unpack the fundamental principles of benefits of multi-asset income investing. Get ready to enhance your understanding of these powerful strategies that cater to both financial growth and security in today's dynamic investment landscape. So sit back, relax, and get ready to learn. So before we formally begin, I'd like to inform everyone that this webinar will be recorded and it will be posted on all our social media platforms, so you can look back to it whenever you like. Whether you are a beginner to the world of finance and investments or a seasoned investor who wants to stay up to date with the latest investment news and strategies, we've got you covered. Our YouTube channel, ATRAM Studio, has a collection of videos that features everything you need to know about finance, investments, our past webinars, and even ATRAM itself. Make sure you subscribe to our official YouTube channel and hit the notification bell to receive alerts on all your devices whenever we upload new videos. For more comprehensive information on all the funds that we offer, you can check out our website at www.atram.com.ph. We also post the latest updates and trends in the financial market in our social media pages. You may follow us on all our social media pages by scanning the QR codes flashed on your screens. So yeah, whether you have some prior knowledge on the topic for today, but have some clarifications or you'd like to ask some questions after the talk, please feel free to send them in through the Q&A tab found below your screens. We'd like to keep this webinar as interactive as possible. Our first speaker for this webinar graduated from Nanyang Technological University in Singapore with a bachelor's degree in mechanical engineering and subsequently a Master of Science in Asset and Wealth Management, where he obtained the Chairman's Award. He also obtained a certificate in quantitative trading strategies from Imperial College London and alternative investments from New York University, Stern School of Business. In 2015, he joined Allianz Global Investors as part of the retail distribution team in Singapore and is now currently serving as the director for the team, who is mainly responsible for handling the relationships and business developments with various business partners in Singapore and Southeast Asia. So without further ado, let us all welcome Mr. Jason Lim.
Okay, great. Thank you. Okay, so good afternoon, everybody. All right. I would just like to would like to say thank you once again for ATRAM to invite me to be this part of this webinar series. Once again, I guess things has actually happened quite rapidly over the course of the last half a year. Okay, whereby I see markets actually rebounding very strongly. All right. I think there has been also a renewed interest in terms of the equity markets, where we see a lot of the investor sentiments coming back after a very challenging 2022. So today, my purpose of this session is really just to share with you all in terms of some of these market developments, and of course, at the same time, highlighting the fact about our US multi-asset, how we can be able to generate capital growth while also providing a stable income, whereas also at the same time protecting the downside when market downturns happens, right? So first slide, I'll just really quick introduction of my company that I work for, Allianz Global Investors. So we belong to the big part of the Allianz Group, and we have been, in fact, providing financial services from the insurance to the asset management over the course of the last more than 130 years. In fact, right now, we are one of the largest asset managers in the world, and definitely very proud to be part of this Allianz Group. So in terms of the US market outlook, okay, I think on the next first segment, I will be sharing in terms of some of these income and growth opportunities, whereby we can look in terms of some of these asset class that provide a good growth potential, as well as also at the same time some income for the investors. So as I mentioned earlier on briefly, okay, if you take a look at the left-hand side of slide number 6 here, that was last year's performance, whereby in terms of sector breakdown, only energy has done well because of the high inflation coming through, whereas the rest of the other sectors was hit due to the interest rate hike that actually happens in March 2022. And of course, we are right now still in the rate hike cycles. I think right now we are still pending for the FOMC, right, to make the announcement later tomorrow to see whether there will be another rate hike coming through, or whether you will really see the last of this rate hike cycle that they have engaged since the course of the last 1.5 years ago. But on the end here, on the right hand side, you can also see that the same thing is said as mentioned. Okay, market has rebounded after a very sharp drawdown last year. Okay, in 2022, whereby most of the sectors has actually contributed positively. The sectors that have been taken a very strong beating last year, from the case of the infotech, the IT, the consumer discretionary, and the communication services had in fact been the one that has been leading, whereas for this year's laggard has been the case of energy. I think this is something that we have seen a very contrast reversal since last year. But again, this is not something new to us, because having invested over the course of the last many decades or centuries, we have seen that this has been the case, whereby whenever there is a sharp drawdown, okay, be it in the case of during the dot-com bubble in 2000, or even in the global financial crisis in 2008, COVID-19 that had just happened, we do see that the next 1 to 2 years is that generally a positive returns, be it whether it's the S&P 500 or the Nasdaq, the composite. And of course, if you want to dig back even further, right, in terms of not just the century of 2000, okay, if you look back in the terms of 1960, this has also been a trend. Whenever S&P 500 index, which is basically the broader US market index, is down more than 25%, generally the next 1 year return is a high double digit, or in fact 20-ish to be more exact, over the course of the history since the 1960s. Obviously, this year, okay, where you see S&P 500 has also moved up to about close to 19% after a huge drawdown of about close to 20% last year. So really, it is on the path of recovery, but also at the same time, this has to do with something what we call on the left-hand side is the maturing Fed rate hike cycles. So we are looking in terms of the tail end of the rate hike cycles, whereby the rate hike does seems to have worked over the course of the last 1.5 years since it started in March 2022 to bring down inflation. So in fact, if you take a look at the latest CPI numbers, the CPI numbers has also come trickling down, and that has showcased that the rate hike cycles could be actually at the tail end, and that is something that again has spelled well for the markets, both in terms of equities and bonds. Not just in terms of inflation numbers, but I think there's also something that we have been much talked about, which I will share a little bit more in depth later on, is that in terms of the economic data. The housing market has also showcased in terms of the signs of stabilization over the course of the last quarter. Since April itself, okay, things have actually started in terms of housing starts, or even the case of the home building confidence that you can see on the top right hand corner of the slides itself. So the confidence between the home builder is increasing as we see more demands of housing continue to outstrip that of the supply, and thereby housing market, which constitute about 16.7% of the US GDP, it starts to have this stabilizing effect, also contributing to a solid economy for US itself. Other than that, the next engine, which is the labor market, continue to be strong. Yes, we have seen the non-farm payroll in June itself coming off slightly lower, but this is something that is much expected and appreciated by many. It's because this is still showcasing that, yes, while the non-farm payroll has come down slightly, but it is still giving a very good, I would say, figures to many of the economies, because it is at least more than 2 times of the expected 70 to 100,000 in terms of replacement job for the working age population. Whereas the unemployment rate still continues to be at a low at about close to 3.6%. So in fact, this is something that the Fed, okay, one of its dual mandate of keeping a strong employment number, a strong labor market working, whereas they are also trying to bring down inflation to a more stable effect, which we have seen that has really starting to take effect. So with that, I think moving on to the next part is really something that is more concerning for us as an asset manager, which is the case of the corporate earnings. Right now, we are in the midst of the second quarter earnings. I think this week we should see some of these big names from the case of the Microsoft, the Alphabet, the Amazon, the Visa, the Procter & Gamble, and ExxonMobil coming in terms of earnings after last week's mixed results from the big banks in terms of earnings. But overall, we are seeing about close to 68% of the companies within the S&P 500 could be actually reporting better than expected earnings. And this is going to continue in the case of not just for this year, but also the course for the rest of the year to 2024 itself. So this will also be one of the reasons whereby when markets has eventually shift focus from this year to next year's fastest earning growth, and therefore, equity markets have also reciprocated in terms of the rally over the course of the last few months. I think when talk about equity market rally, we can't miss out the fact about in terms of talking about artificial intelligence, because in fact we have seen that over the course of the last 6 months, artificial intelligence has definitely played a big part in pushing some of these stocks from the Magnificent Seven to even the latest now more of the broad-based companies that adopt AI, has positive impact on their profits. In fact, a survey done by us over the course of the last few months is that they have seen that the investors think that for AI will have a positive impact on the profit, for many of the companies over the course of not just 1 year, but the next 2 or 3 years effect. So this is something that is really probably spelling well and providing some tailwind in terms of the profitability for the companies that we appreciate as investors, as a company investor. Moving on, talking about valuations for equities, while market has been on a very good recovery, but when we look at the price to earnings for the 2023, which is still right now at 19 times, as you can see for the S&P 500 on the left-hand side of the rectangle. Okay, compared to that of the pre-COVID of 2019, okay, it is still generally lower. And what does this mean? With a lower PE, it basically means that it is still relatively attractively valued, okay, at this juncture, even though the market has been on a good recovery over the course of the last 6 months. And definitely for equity investors, right, there we do see that there could be more potential for this second half of the year for the markets to continue rising. Moving on to the next asset class, which is in this instance the high yield bonds, which we do see that there could be a good component to invest into. Okay, high yield right now in terms of US high yield is giving about close to 8.5% in terms of yield. All right, and this is definitely something that could provide investors with a very attractive total return profile. Not just in terms of 8.5% yield in US dollar terms, but also at the same time on the technical front, right? The high yield returns or high yield prices right now is still looking at below par, which definitely gives a very nice proposition for many of these capital appreciation to come through. And also at the same time, on the top chart, okay, we have seen that whenever high yield bonds has gone on the negative year returns, like what we have seen in 2022, all right, the next 1 year is actually generally tends to be positive. Okay, this has been 1990s, and it's not just happened once, twice, or twice, but it has in fact happened 7 times since the case of the last 30 years. In fact, right now we could be having the 8th box that you can see in the dotted line, all right, forming at the end of the year if the market continue to rise up positively for the high yield bonds market after a very challenging and disastrous 2022 itself. So on the technical front, this is something that spells well, but of course I have to highlight the fact that its past performance is not indicative of future performance, but it could be looking in terms of some of these patterns that are generating from the trend, right, of these high yield bonds. And of course, moving on to the fundamentals, which a lot of times that we look at is that high yield default rates continue to remain low, right? Right now, we are looking at about close to 1.53% in terms of issuer weighted numbers of the default rates. We still generally think that after a recent credit crisis in the case of 2020 due to COVID, when there was a strong pickup in terms of the default rates, predominantly in the triple Cs, okay, of about close to 6+%. Right now, it has tends to normalize, looking at about close to 1.5 to 2%. So this is something that we are appreciating in terms of this fundamentals. And why are we still positive regards to this high yield asset class is really the case of the fundamentals. So we do see that the fundamentals in this instance, right, has been looking really well. Okay, I would say the leveraging factor for many of the companies have come down, whereas also at the same time, the interest coverage ratio has actually gone up. So what does this mean? High yield credit issuers have the good balance sheet to deleverage, whereas also at the same time paying off some of these coupons or bond payments that is due for the investors. Another attributes towards the fundamentals is really the case of the refinancing obligations, where we see that the near-term refinancing obligations to remain low due to the maturity profile of the high yield issues. Because in 2023, we're expecting only about 5% of the entire high yield market to only needs to refinance, whereas in 2024, only 20% of them needs to refinance. So really taking away this toll on many of the high yield issuers to refinance at a high interest rate environment right now. Why has this been the case is because in 2020 and 2021, when the interest rate was low, many of the high yield companies have actually made use of the opportunity at a low interest rate environment to issue many of their high yield bonds. And when we talk about high yield bonds, typically they last for at least 5 to 7 years. Okay, typically around that period. So the next time the maturity, the huge maturity comes through, will be generally within the 2025 or beyond. And by then, probably interest rate will also be slightly lower as what we are seeing right now, especially when inflation comes down, showing signs of coming down over the course of the last few months and expected to come down for the next few months or years ahead. So moving on to the next asset class, I think really in terms of that, where can we find a very good hybrid securities between equities and bonds? This is really the case of the convertible bonds. Why do we say that? It's because convertible bonds is, after all, a hybrid security between a bond and equity, whereby it's able to give the downside protection like a bond, whereas also contributing some income through these coupons, but also at the same time, it has this equity warrant or equity options that is embedded in this product or in this asset class that is able to make use or capitalize on this upside participation of the stock. So this is the chart to showcase to you in terms of the historical performance of convertible bonds versus S&P 500, and you can see that while returns, convertible bonds has been able to give a generally good return, right, versus the S&P 500. Okay, the fall in this case is definitely much lower compared to a pure S&P 500. So this could be an alternative to for equity proxy or proxy to the equity, right, to invest into the US market itself. So hereby, I have actually covered a three asset class of the bonds, high-yield bonds, the convertible bonds, as well as the equities right now. So I'd like to make use of the remaining time that I have to really highlight in terms of our one of the flagship product that we have, which is the Allianz Income and Growth Fund, which is a 5-star Morningstar rated fund, and that is where the ATRAM multi-asset is feeding into towards. So what is this fund? It's an equally weighted portfolio of high-yield bonds, convertible bonds, as well as equities, and we have the track record over the course of more than 10 years to showcase to you whereby we are able to capitalize on upside potential of equities and a potentially lower level volatility than a pure equity play. And of course, the portfolio manager team that sits here in the Allianz itself has been more than 20 years of investment experience. Talking about multi-asset investment, I think this pie chart of one-third has been the case whereby it has been playing very nicely for us over the course of the last many years since the strategy incepted, providing a good downside protection from the convertible bonds and the high-yield bond sleeve, whereas also at the same time having the kind of income, be it whether it's a coupon income from the high-yield bonds or the coupon income from the convertible bonds, or even the dividend income for the equities that has been the component of the income generation, as well as the capital appreciation coming through from all of these three streams. So this really forms you the case of the very dynamic, I would say, very diversified kind of multi-asset investments. Okay, here you can see the performance as of end June. We have done pretty well in terms of the performance on the year to date at 10+%, and over the course of the last 1 year, 3 years, or 5 years, or even since inception, we have definitely performed generally well in terms of generating a good total return for our investors. Okay, not just in terms of generating good returns over the course of the last many years, but also at the same time, the solution is able to participate in the upside potential of equities at a lower level of volatility than a pure equity play. What do I mean by that? Since inception, the Allianz Income and Growth has been only viewing a beta of 0.68 and a standard deviation of only 10.7, and this is definitely much lower than compared to the pure equity play of 1 in terms of beta and standard deviation of 14. And another thing that I just want to attribute to the track record is that since the fund started in 2012, right, on the rolling 36 months period, which is basically 3 years period, the Allianz Income and Growth has never delivered any negative returns on the 36 months rolling or 3 years rolling period. As you can see from the bar here, period. This is the team, as you can see, whereby our CIO, Justin Kess, is about close to 25 years of experience, and of course, he is helped by a very strong team, a very experienced team that has on average about more than 20 years together. So this is something that speaks very strong volume of our track record and of course the experience of this Income and Growth team. And this is the AUM that the team manage, which currently sits just below 60 billion in terms of the entire strategies that they manage. So with that, I've actually come to the end of my presentation. I would just like now pass the time back to Christine.
So yeah, thank you very much, Jason, for that very insightful talk on multi-asset income investing. It really is important to know key strategies when it comes to using such a technique, the different ways multiple assets can reduce risk by spreading investments and their behavior during market fluctuations, and also how combining various income generating assets can lead to higher overall income. With that, we're done with the first segment of our webinar, and I hope that our audience enjoyed and learned a lot from it. So yeah, our next speaker is a graduate from Ateneo de Manila University with a degree in BS Management, minor in Enterprise Development. He is the Growth and Partnership Manager for ATRAM Digital Channels and also the Growth Manager for ATRAM Prime, ATRAM's investment platform that allows users to invest in a simpler and much smarter way. Let's give it up for Ross Santos.
All right. Thank you. Thank you, Tin. And good afternoon, everyone. So to start, what do many people think about when investing in the US market? I, for one, especially from a few years back, would think about NASDAQ, Silicon Valley, Wall Street, S&P 500, all of these jargons and buzzwords that may seem daunting or familiar, depending on how knowledgeable one is already about the US market. As an investor and as someone who invests coming from the Philippines and who wants to invest in the US or abroad, there are a couple, this seems to add another layer to that feeling that it seems intimidating, it seems so scary. It gives off also the question on the questions of how do I even start to invest in the US? Where do I go? Do I have to invest in US dollars? How volatile is it? When is the right time to buy? All of these questions are valid to ask, and I feel you when some of you might feel that it can be intimidating or really is scary at times. More so, just taking a step back and thinking about investing in general. There is a human element to it that when markets are up, would everyone would just go in because everyone wants to ride that wave of the uptrend. And the fear of missing out. We don't want to miss out on that big opportunity. However, on the flip side, when the markets are down, people would, all of us would seem to panic and sometimes would just sell everything. So there's that complexity with this psychology and with the many questions that would seem overwhelming that makes investing abroad seem scarier sometimes. Some scarier than usual. But what if there is a fund that tries to address those fears where, number one, yes, you can invest in the US market, but in such a way that isn't as risky as or isn't as daunting as it seems. So this is where the US multi-asset income feeder fund comes in. With the target fund being the Alliance Income and Growth Fund, this fund seeks to achieve income and long-term capital growth by investing in assets from the US. It has three main features. Number one, it is an income-paying fund and more so an aggressive fund. As such, it provides higher yields, as what explained by Jason earlier. It captures growth. So not only are you growing through equities, but you're also growing through fixed income, which I'll show in a bit through convertibles and high-yielding bonds. And third, given that it is a mix of equities and hybrids and fixed income, it does create a balanced and diversified portfolio where in times that are good, you can really ride the highs, and times that are quite tricky, quite challenging, like last year, the lows are slightly minimized, or you can actually resist those lows. So onto the next slide, please. I want to just share with everyone what this fund is made of. So it's a mix and match of many different things. 1/3 of it is equities. So modeled after the S&P 500, it gives you, the investor, the opportunity to grow with the likes of Microsoft, Walmart, the Procter & Gamble, all of those big companies in the US with high earning potential as well when they grow. And the other 2/3 of it are fixed income through high yielding bonds, as well as convertibles, which Jason earlier explained to be a mix of that gives both the benefits of both a bond and a stock, which given this, it does provide a good potential to earn, but yeah, it does also provide you the a lesser means to a lesser risk versus just putting everything in equities. So given this, when we look at the next slide, please. So in this slide, I think I will just want to share with you two main stories. So the first is that if the market is good, we're able to take advantage of this opportunity and your money does really grow with it. On the flip side, if the market is not so good, not only is the fund designed to soften the blow because of the fixed income components of it, but with the income payout, you as an investor can still gain something as we weather through the storm. So markets are bad, all securities are doing not so great. At least with that income payout, you could still in a way sleep at night because you have that cash that you can get on a quarterly basis. So, and next slide, please. And talking about these income payouts, what's special about this fund is that this fund actually declares income on a quarterly basis, as it mirrors the dividend payout of our target fund, Allianz. It also has an auto redemption feature where investors can receive this regular stream of income without having to think about it too much, and you'll just receive a notification every few months that says, oh, you got your unit income already. But of course, given everything, right, this is a fund, this is an investment, so it always would pose some risk. So there's always that disclaimer that number one, current performance is not indicative of future performance. Second, while historically there are income payouts, there are good yields that investors are getting, it cannot always be a guarantee. Nevertheless, given all this information, it is also your responsibility as investors to do your research and to reach out to us whenever you have questions about investing or about this fund. Which brings me to the next question: where do I start? Yeah. So if number one, if you're an aggressive and a long-term investor, meaning you can invest in 5 or more years and you're ready to jump right into investing in this fund, or if you want to invest in the S&P 500 without really fully embracing the risks, because it can be scary, you can start investing in the US multi-asset income feeder fund through the ATRAM Prime app. Which brings me to my next slide. Yeah, so in ATRAM we have our app ATRAM Prime. It is our premier investing app for on-the-go investors such as you. And we can do that in 3 ways. Number one, it's convenient, it's personalized, and number 3, it's award-winning. It's convenient because it offers a user-friendly platform through the mobile app. It's personalized because, as I've mentioned earlier, you can reach out to us in ATRAM Prime through client advisors, which I'll explain in a bit. And thirdly, it offers an award-winning suite of local and global funds, such as this US multi-asset income feeder fund, as well as retail treasury bonds and T-bills. So what I'll do over the next couple of minutes, after talking about the fund, is I'll quickly walk you through the ATRAM Prime experience as well. So you can start investing in this fund in a simpler and smarter way, and really take advantage of growing your capital and earning income and accessing this sort of global opportunity. Next slide. Yeah. So as mentioned, it is a premier app for you, the mobile investors. So next slide, please. So with ATRAM Prime, you will create what you'll have is what we call an investment management account, or IMA. For those that are not aware or not super knowledgeable about it. In the simplest way possible, an IMA is your all-in-one account that can serve as your portfolio. Versus local banks, creating an IMA often requires hefty deposits, sometimes going over ₱1,000,000 and above. It would take weeks of submitting requirements, going to the bank. It takes a lot of signatures, which can be quite stressful. But with ATRAM Prime, you can start investing in funds such as the US Multi-Asset Income Feeder Fund for as low as ₱100,000 in as fast as 8 minutes. So given this, you can unlock the fund that we've been talking about, but also the 20 plus more funds that ATRAM has to offer, such as the ATRAM Peso Diversified Income Fund, ATRAM Global Equity Opportunity Fund, and even retail treasury bonds and T-bills. So a lot of investment opportunity is on your doorstep just by setting your IMA in only as fast as 8 minutes. No more long lines, everything's on your phone, no more going to the bank. All is quick and all is easy. So next slide, please. And given that everything is on your mobile phones, managing portfolio can be done now through your mobile phones. So we understand that, as an investors, even for me, it's all we want is to grow our money in the best and most efficient way possible. Just want to look at a single platform, single thing. So as investors, we want you to feel like you're in control and you're well informed also about your investments. So with ATRAM Prime, since everything is on the app, you can buy and trade there, you can get your information there, you can manage your portfolio in real time. And with our portfolio view, fun fact, we're one of the few in the Philippines to actually offer this. It's a really great opportunity for you as an investor to take care of your portfolios all through a single view. Next slide. And not just by doing it yourself, looking at the app, we also have our dedicated client advisors. So as investors, many of us would want to talk to someone who would be our sounding board, who would help us out whenever we have questions about the app, about the market, about investing. So we have our client advisors available for you to provide personalized service and to provide tailor-fit investment recommendation to really help you go through your investment journey and ultimately reach your financial goals. Next slide, please. So in ATRAM Prime and in ATRAM Prime in general, it's very important for us to not just go straight right at it and jump into this swimming pool of investing. We also care about your risk, your appetite for risk, and therefore it also matters to us to really be knowledgeable about your risk level. So in this slide, you can see here the very many questions that we ask you, that gives us sort of an idea of how much risk you want to take and how much risk you can actually take. And coming from this, next slide, please. It allows us to create a portfolio that best suits you. So for example, for the US Multi-Asset Income Feeder Fund, it's an aggressive fund, meaning you shouldn't put all of your eggs in that single basket, though it is diversified by itself. Nevertheless, it's still healthy to also allocate some of your funds in more conservative funds, such as the peso money market, just so that you'll be able to have a diversified portfolio. And as we all say here in the investment business, diversification is indeed king. Next slide. And finally, award-winning, as I mentioned earlier. So in ATRAM Prime, you can have exclusive access to ATRAM's award-winning funds. You can have access to income-paying funds, such as the US Multi-Asset Income Feeder Fund. So not only are you investing in funds that are made and continues to be actively managed by experts with many years and decades of collective experience, but you're also giving yourself exposure and you're opening your doors to investing in a diverse array of investment products, whether it is income paying, whether it is of different asset classes, of different strategies, of different regions, say it's Asian focused or US focused or globally focused. So given all of this, Next slide, please. Given all of this, it really does make a great investing experience with ATRAM Prime versus our competitors in traditional banks, and online brokerages. It's very convenient to create your investment management account. It's very easy and very convenient for one to create their portfolio and really explore the many different investment opportunities through different asset classes, through different regions, all in your single app. Plus, there's always a great benefit to have someone to talk to through your client advisors. So given this, not only is the US Multi-Asset Income Feeder Fund a really great investing opportunity, given everything that Jason and I have shared over the past few minutes, but with this platform, it's a great platform for anyone to start also investing in the US multi-asset because of many more reasons that I just shared. So as an invite, next slide, I'm inviting everyone to become a Prime member in just 4 easy steps. Very, very efficient, as fast as 8 minutes. And then after that, through bank transfer and bills payment. Next slide, please. Yeah. It's very easy for one to really just put money in. And next slide, please. Yeah, bank transfer, bills payment, and next slide. Yes, you can start investing. You can start putting money in the ATRAM US multi-asset, and as early as today, you can start growing your capital. So let's not waste any more time and any opportunity. I'm inviting everyone to next slide. Download the ATRAM Prime today and invest in the US Multi-Asset Income Feeder Fund. Thank you. Thank you very much.
Thank you very much, Ross, for enlightening us on the ATRAM US Multi-Asset Income Feeder Fund and also on how to navigate the ATRAM Prime platform. So my personal takeaway is that this fund is perfect for risk-averse investors like me, since it has equal exposures in 3 different asset classes. And also, yeah, as Ross mentioned earlier, never put all your eggs in one basket. So yeah, now I'm sure our dear audience might have some burning questions right after our speakers talk for this afternoon. But before anything else, we are pleased to announce that ATRAM has clinched several awards this 2023. ATRAM was hailed as Best Investments Solutions Provider, both by International Business Magazine Awards and World Business Outlook Awards. The company also received Most Innovative Fund Management Firm, Most Innovative Fund Offering Company, and Asset Management Company for the year. Highly commended from the Asset AAA Sustainable Investing Awards 2023 for institutional investor, ETF, and asset servicing providers. And just recently, ATRAM won awards for Best Asset Manager from Citywar ASEAN Awards 2022-2023 and Best Fund Management Company from the annual Global Economics Awards. These recognitions serve as a testament to our unwavering commitment to creating cutting-edge investment solutions. We believe that our unique approach to managing assets and funds has assisted our clients in achieving their financial goals. As a result of our team of experts' steadfast pursuit and excellence in innovation in asset and fund management, we are dedicated to continuing to push the limits of what is feasible in the investment industry. We appreciate your continuing confidence and support, clients and partners. So yeah, now we will be moving to the question and answer portion of our webinar. And since we'd like this webinar to be as interactive as possible, please send in your questions below. So right now, I'm actually seeing several questions coming in. So don't be shy and feel free to send in your questions again. So the first question I'm seeing here is for Jason. Hi again, Jason.
Hello, hi, Christine.
Hello. Yeah. So the first question here is for you. The 10 to 2-year Treasury yield curve is still inverted, and it has been an indicator of recession. What's your view on recession and the impact on the financial markets?
I guess it is probably generally right. Okay, in terms of the yield curve, which we talk about 10 minus 2 years Treasury, it has been inverted since last year, March 2022, right? And of course, generally, 8 out of 10 times, it has been a good indicator of recession. However, having said that, it does not really determine the severity and the timing of the recession, right? So a recession could be actually just a very short or technical recession that does not impact the financial market at all, or it could be something that is very long drawn, as what we have seen in the 2008 global financial crisis. But the thing is that, having said that, right, we do see that the recession after the yield curve inverted could actually take place up to quarters or even many years before it comes. And sometimes it is just be a very mild recession where the equity markets continue to be on a good run. I think something that I just wanted to highlight here in this case for the specifically, and also to share with you our views, is that the yield curve inverted last year, as I mentioned earlier on in March 2022, and right now it is still inverted, as obviously not as inverted as previous year. And in fact, we have been hearing about this recession happening over the course of the last 1.5 years. It is really more of the most highly anticipated recession since everyone started talking about it in March 2002. But having said that, just looking at the US economic data that is just right now, as also presented earlier on, the CPI number, which is the core price inflation number, has actually coming down, and we showcase the inflation is starting to slow, but has been the effect of the multiple of the interest rate hike that has come through since last year. And of course, at the same time, the labor market, all right, has definitely continued to be strong. So the so-called dual mandate of this Federal Reserve, from the maximum employment as well as the stable prices here at a sustainable inflation number, is starting to come fruition, and that is also partly the reason why we are seeing the tail end of the rate hike cycles. With this probably next to tomorrow's 25 basis point already much anticipated and priced in by the market. So having said, talking about you, since we have started talking about it over the course of the last 1 year or so, is that in fact the latest survey showcasing a lot of the economists from global financial institutions have shown that 71% of them think that there should be no recession at all for this year, even until late 2024. Because of the robust US economic data and condition. So I think this is the view on the recession on the first part of the question. And what is the impact on the financial market? I think something that we wanted to highlight is that market has rebounded very strongly since last year. In fact, last year's decline, which was a very challenging year in 2022, whereby the equities and the bonds market was all both down, have in fact pretty much affected the impact of the yield curve inversion already. So going forward, I think we do see a lot more potential for the market to recover, especially with the tailwinds that is assisting this boost of the market further. Like for example, in terms of the likelihood of the US recession continue to fade, the inflation numbers continue to trend lower, and of course at the same time, when we see that the Fed rate hike cycle is coming to an end, it tends to be a positive development for stocks. So not just by us, but this is also from the Goldman Sachs Investment Bank. The US equities generally rally in the months following the end of the Fed rate hike tightening cycle. So we are really now at the tail end. In fact, when we look at it, January on a 12-month basis, the S&P 500 actually rise by 19%, rising 5 out of 6 episodes during the rate hike cycle. So this is something that has already probably materialized against the sixth time of the 7th episode, as we are nearing to this end of the Fed rate hike cycle. So I think generally the impact on the financial market could be actually more positive, but not really due to the yield curve inversion, but really due to the strong economic data as well as the corporate earnings itself.
Okay. Thank you for that. Yeah, it's actually very interesting to know that the general outlook is still positive, even if the recession is usually recession usually connotes like a negative impact on the market. But it's very interesting to know that the general outlook is still positive for the impact. So yeah, thank you for that. Appreciate it. Next question. This is, I think, for Ross. Hi, Ross.
Yes, hello.
Hello. So yeah, I'm seeing here a two-part question for you. So the first question from one of our audience is, if I'm just starting to invest, would you suggest the fund as a good way to get started with the US market? And then if so, could you also let me know what type of investor would find the fund's goals a good match? Let me know if you want me to repeat the question.
No, I get it. Okay.
Okay.
So the first question pertains that if you're a starter, this be a good way to start with the US market. And the second question is depends on what type of investor you are. Would this fund be a good match for you? So for the first question, yeah, definitely. So as I was explaining earlier, this fund provides a very diverse way of approaching or investing in the US market. So not only are you investing in just pure equities, but you're also investing in convertibles and high yielding bonds, which are primarily fixed income. So given this, it's a multi-asset investment, multi-asset strategy. So what the very interesting thing about it is that given that you also are exposed to equities, you can ride the highs, but given that you're also invested in income whenever there are lows or whenever there are slow times in the market, you're pretty much buffered. You have that buffer. And on top of everything, this, as mentioned earlier, this is also an income paying fund, meaning you can sleep soundly at night while your capital is just sitting there growing for many, many years to come, because you're continuously getting some sort of income every few months, every quarter. So hope that answers the first question. So for the second question pertains again to what type of investor. So if you're an aggressive investor, I think you can put up around 60% of this fund into your portfolio. So for example, you have 100,000 peso portfolio, 60,000 you can allocate into the US multi-asset. If you're moderate, around 40% or 40,000. But if you are around conservative, moderately conservative, would recommend around 20% of your portfolio, around 20,000 if given 100,000 peso. So I hope that answers the question. Actually, I was reading that question also earlier from the Q&A. Yeah, hope I answered your question. Thank you.
Yeah, he answered that question. And yeah, just to reiterate that, I think this is a good fund for those risk averse investors, since as you mentioned, they can peacefully sleep at night knowing that they're not as exposed to the equities as opposed to other riskier investments. So yeah, thank you for that.
You don't want to sleep having nightmares because financial problems, no?
Yeah. Thank you for that. So next, we also have here a question again, I think for Jason. So the question is, do you also have REITs in the USMA Income Feeder Fund?
We do have some allocation towards REITs, but not in a big fashion, because we have about close to 485 securities for this very diversified portfolio. So I would say that we do have some exposure towards REITs, but not in a big way like a pure REITs fund.
Okay, thank you. And yeah, I hope this answered the question of our dear audience. So yeah, we have here.
Can I add something also?
Yeah, sure.
Yeah, so just for our dear investors here, so the income is primarily sourced also from the coupons from the high yield bonds. So yes, as Jason mentioned, there is some allocation, but it is not the main proposition. We have to also note that this is actively managed by dear friends in Allianz. So definitely where we see the opportunity for maximum growth given market scenarios, that's where we go for, and that's what we see in the high yielding bonds, the convertibles, and the equities. Great stuff.
Okay. Yeah, thank you for that, Ross. So yeah, I hope it answered our audience question on REITs. And then yeah, we have here a few more questions, but if you want to send in, you may still send them in through your Q&A tabs. So next we have here again a question for Jason. So it's related to artificial intelligence and we have seen a rally led by the artificial intelligence related stocks since the start of the year. How do you see this trend going forward?
Again, absolutely right. In fact, it's not just this year, but since late last year when we have the ChatGPT reaching that 1 million subscriber within a short 1 week of opening in November, and then reaching about 100 million within the case of the 6 months since it launched. So I think obviously the last since the start of the year, there has been a lot of some of these mega cap stocks, like for example now what they call it magnificent seven stocks, from the Nvidia, from your Alphabet to your some of your Meta even, right, that has actually been riding on this AI wave since the start of the year. We have seen that it has somewhat slowed down in terms of some of these mega stocks in terms of their huge rally, especially with regards to the course of the last couple of months or so since May itself. But fret not. In fact, we have seen from that end April onwards. Okay, so the rally actually started from late last year to probably end April within the 7 stocks, quite confined towards the 7 stocks. But over the course of May, June, and even right now for the last 2 weeks in July, right, it has actually expanded towards the case of the other non-mega cap tech stocks or even outside the tech space. So in fact, we do see, right, even from yesterday, the Dow Jones Industrials index has actually been on the longest streak since 2017. This is a telltale sign that it has actually continued to reap the benefit from this expansion of this AI wave towards some of these non-tech companies. So I think this definitely has been the case whereby we do see the trend continuing. In fact, what we are looking out here is really early signs of this AI wave. We do have survey that in fact many of the companies, okay, not just in US itself, but globally wise, thinks that adopting artificial intelligence into their business will help to reduce the cost and also at the same time improve productivity. So this really generates the kind of top line growth numbers coming to them, while also at the same time saving on the bottom line. So this is really something that we do see having a positive impact on many of the company's profitability, and we do like that aspect, especially coming from a company investor. So I think the trend will continue, okay, but it's just whether in this instant, okay, whether clients or investors like yourself is making use of the opportunity right now to buy into some of these stocks, or especially the sentiments have actually improved due to the AI.
Yeah, very interesting to see artificial intelligence related questions in our Q&A for today, since it has been a trend these days. So yeah, I hope our audience got something from this question also. So next we have here, I'm seeing here a question also for Ross again. So hi Ross. We have here a question from our audience. As someone in my 30s and looking to invest in the US market, I'm interested in the ATRAM US Multi-Asset Income Feeder Fund. But I'm a bit worried about the risks involved with convertible bonds and high yield investments. Could you tell me how the fund handles these risks and ensures that investors' money is protected?
All right, sige. All right, so if you are in your 30s, so usually the goals of people around that age group is that you really want to save already for, so you have a family, really planning for your children's futures, for their education, etc. Or if you're just entering your 30s, really like planning like more long term, like how buying your own house, getting your own car and all that. So do understand that at this stage of life, kind of want to balance your risks, right?
Yeah, and more stable investments. Yeah.
Definitely, you want to put it into more stable investments, which I think the US multi-asset fund does provide. So just taking a step back and reviewing what we were discussing earlier now. With the US, with this fund, it's a mix of equities and fixed income. So the way it balances out is that number one, diversification is king. And secondly, given that it is a multi-asset approach, when equities are up, your fund grows with it, your capital grows with it, and if things are quite bad, like last year, there is some sort of buffer. There's that is being provided by number one, the income payout. So your money could just be sitting there, and you could still be getting cash on a frequent basis. And secondly, with the fixed income, it kind of softens the blow of when things go down, because it just really balances out. And over time, in terms of volatility, generally when you have investments, more so investing in even in aggressive investments, aggressive securities, aggressive funds, over time the volatility sort of stabilizes itself anyway. So given this, if you're in your 30s and want to invest in the US stock market, I think this is a good opportunity for you. As long as number one, you continue to do your research. Number two, when the market goes down, don't sell, just hold. And number three, good opportunity because it's an income paying fund, as I've said a lot of times, because it really is a great benefit it's a really great feature of this fund. It gives regular payout. So regardless of the market situation.
Yeah, okay, got it. So that's actually a very relatable advice and relatable answer to this question. I'm sure several audience would relate, since we're also, I think, since even I am also in my late 20s, so I can also relate to the risks and fears when it comes to investments. So yeah, unfortunately, we're running out of time. So we have room for, I think, our last question. And this question is also again for Ross, since this is related to our app, the Prime app. So for you, Ross, is the app beginner friendly, and does it offer customer support to assist users who may have questions or issues? So this is also two-part. The next question would be, what is the minimum investment required to start using the ATRAM Prime app?
Okay. So answering the first question, yes, it's beginner friendly. If you need anything, we have our client advisors that can walk you through the entire app. Or if you encounter any questions, any issues with the app, they are people that are there to really help you make your investing experience as good as possible. And it's one of our favorite features in the app as well. On the second question, the minimum contribution for an IMA and for the ATRAM Prime is 100,000. In my view, in creating a portfolio, and more so a diverse portfolio, it's good to have one big capital that you allocate. Just so that you can't really diversify with $100 or 10,000 pesos. You can really diversify with a larger sum of money. So that's why it's pretty much 100K at the moment.
Okay, so I hope that answers our audience question for today. And unfortunately, that is all the time that we have for questions. But before we part ways, do you, Ross and Jason, have any last words for our audience?
I guess I'll go first. I guess for those who have not been making use of the opportunities since last year, right, to start investing, I think this is still not too late, because especially with the economic conditions looking much better than compared to last year ago. So this could be something that not to miss out again. It's never too late to miss the boat. It's really better late than never, right, in that perspective. So I think really making use of the opportunity to start investing to make your money work harder for you.
Okay, thank you, Ross.
Yeah, I just want to build on what Jason said, right? So there is really a great opportunity when you start investing and building your portfolio as early as now. I think in terms of timing, though, A lot of us would think, oh, what's the best time to invest? The best time to invest was actually yesterday. So the second best time is now. So I think it's a good opportunity to invest now. Do your research. We've shared a lot of information, Jason and I, and even Tin. So it's still a good habit to continue, like, doing research, trying to understand how the markets are working, how the funds are built. And through the ATRAM Prime app, if you have any questions, just also call your client advisor. So if you're ready to start, we're very much excited to talk to you, to see you. Thank you. That's all.
Thank you. So once again, we'd like to extend our gratitude to Jason and Ross for providing us with very actually relatable and great insights for this webinar. And of course, to you, our dear audience, for your active participation. We sincerely appreciate you taking the time to join us today. So now, ATRAM Prime provides access to a wide range of investment options, allowing you to customize your portfolio based on your goals and risk tolerance. With a commitment to long-term growth, ATRAM Prime's expert fund managers employ proven investment strategies, guiding you towards building assets that withstand the test of time. For more information, check out the video flashed on your screens.
Good day. ATRAM is the leading independent asset and wealth management company in the Philippines. If you are interested in investing in ATRAM Prime, download the app in the Apple App Store or in Google Play Store. You can also visit prime.atram.com.ph to know about ATRAM Prime. If you have other questions, you may fill out the contact form on our website or send an email. We hope this helps. Thank you.
Okay, so whether you are a beginner to the world of finance and investments or a seasoned investor who wants to stay up to date with the latest investment news and strategies, we've got you covered. Our YouTube channel, ATRAM Studio, has a collection of videos that features everything you need to know about finance, investments, our past webinars, and even ATRAM itself. Make sure you subscribe to our official YouTube channel and hit the notification bell to receive alerts on all your devices whenever we upload new videos. You may also access our official social media pages by scanning the QR code found on your screens. Before we let you go, we kindly ask you to complete this feedback survey by scanning the QR code flashed on your screen. Your feedback on today's topic will be extremely useful for us in our future webinars. So again, on behalf of everyone at ATRAM, we sincerely thank you for your participation this afternoon, and we hope to see you again in our next webinar. Once again, I am your host, Christine Bernales, and would like to wish you and your loved ones continued health and safety. Good afternoon and have a great day ahead.